Zoom Communications reported quarterly financial results after the stock markets closed on November 24th, 2025. And on the day after the company announced those results, the stock price is up almost 11% because investors were very happy with the results, and Zoom Communications upgraded their expectations for the full year in 2025. Of course, I'm happy about that because I've had Zoom Communication rated as a buy all year. So I'm happy to see the stock price jumping following these results. So I'll update you on my latest buy or sell rating following the earnings release. But first, I'll review the company's earnings results and highlight what they could mean for you as a Zoom Communication stock investor.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So like I highlighted, the stock price is jumping following the results. It's up over 10% now. Coming back down a little bit, it was up as much as 12% on the day after the earnings announcement. So Zoom is repurchasing a lot of its shares, and I typically like to see this from management teams, especially when I feel the stock is undervalued, which I do feel and have felt with Zoom Communications here. They repurchased approximately 5.1 million shares in Q3, bringing the total shares repurchased under the plan to 32.5 million. Furthermore, they increased their repurchasing plan by another $1 billion, adding to the incremental 310 million remaining as of October 31st. So this management team has felt confident that the shares are undervalued, and I've agreed with them all year here in 2025 and even last year. I had Zoom Communication rated as a buy. So in the most recently completed quarter, total revenue came in at 1.23 billion. That was up 4.4% year over year. Remember, Zoom Communication was a pandemic darling. I mean, you couldn't think of a better stock during the pandemic. The company benefited as students and workers were moving to remote locations and working from home and learning from home, communicating from home, all of which benefited the company significantly, and revenue and profit soared. Ever since the economic reopening, investors were concerned that its revenues would collapse, but they haven't. They've just stopped growing at the rates that they were growing during the pandemic, and that's obvious, but they've held up relatively well. What's been more impacted has been the company's profitability, which took a decline ever since the reopening because the company had to work harder to keep those customers. They had to increase the sales function, communicate more with customers, offer better terms and agreements for longer term contracts. Competition increased as people went back to work, and offerings from others like Microsoft and Alphabet created a more difficult operating environment compared to the relative ease it experienced during the pandemic. But still, this is a very profitable company with operating income in the quarter coming in at 310 million, and that's roughly one fourth of its total revenue or a 25% operating profit margin, which is pretty solid. And the company's cash flow is actually better, and we'll look at that in just a little bit. So since they've been very profitable, at least in terms of cash flow, for some time now, their balance sheet is in absolute pristine condition. As of October 31st, they had $8 billion on the balance sheet. $8 billion. And so I'm happy to see that with this kind of a balance sheet and this low of a stock price, that management is using this cash to repurchase shares and reduce the number of shares outstanding. The cash flow from operations at 630 million was up from 483 million in the same quarter last year. And if we divide that with the revenue figure, we'll notice that its cash flow from operations to sales ratio is above 50%, which is among the best of any company that I follow. And this is due to the company's asset light business model. The tech and the research and development it needed to undertake to build this platform is mostly behind it. And now it's incrementally investing in making the platform more useful to its users. And that, I believe, is a good time to highlight the company's biggest competitive advantage. And that is that during the pandemic, millions and tens of millions and perhaps hundreds of millions of people got used to the Zoom communication, the Zoom video platform. People were using it and getting familiar with the platform. And so now they've become more accustomed to this. And so when they're choosing a video provider, they're more likely to go with Zoom because they feel comfortable. They used it. Maybe some of the students, some of the people that are in working class environments right now were students during the pandemic and they got to use the platform because their university or their elementary, middle, or high school was using the platform. And now, when they need to use the platform again, when they need to have a video conference, they go to Zoom instead of going to somebody else. So, Zoom has the first opportunity here to gain those customers because it has familiarity with so many individuals. And that's the biggest competitive advantage. That's going to be difficult for even the larger players to encroach upon because Zoom has that convenience factor attached. People don't want to spend time learning what Google Meet can offer or what Microsoft Teams can offer, even though they do offer compelling products, even arguably better products than Zoom communication, and they have deeper pockets. What they don't have is that user base with familiarity with the platform, and that's proving to be a significant advantage post pandemic. One thing that concerned me is its trailing 12-month net dollar rate for enterprise customers came in at 98%. So any figure at less than 100% means that existing customers are spending less with you in their second year of service compared to the previous 12 months of service. I like to see a number above 100% because that demonstrates that customers are seeing such a good value that they are increasing their spending with you. But for Zoom, it actually went down, and it went down slightly. And this is most likely due to changes in pricing agreements as customers probably asked for discounts, and Zoom communication was more willing to offer customers discounts to keep them on board, to get them to renew their contracts. Overall, it demonstrates a declining organic demand environment for its products. And that's my biggest concern for Zoom communication. That competitive advantage I highlighted earlier is something that might be prevalent right now, but as time goes on, the bigger pocketed rivals like Google and Microsoft are likely to chip away at that advantage. And I don't think there's very much that Zoom communication can do about that other than continue to deliver incremental improvements and hope that existing customers continue to renew and like the features that Zoom communication is offering. So the management team expects the good times to continue. Total revenue expected to come in at 1.23 billion again in the fourth quarter, with overall fiscal year 2026 revenue to come in at about 4.85 billion. And look at this here. The full year fiscal free cash flow expected to be roughly $1.87 billion. So this is free cash flow, not cash flow from operations, and free cash flow incorporates capital expenditures in addition to the cash flow from operations, and that's a very robust free cash flow to sales ratio, and this is the attractiveness of Zoom communication for investors. It's not going to be a fast-growing company again anytime soon unless they come out with some innovative product that accelerates growth, which I'm not expecting. However, I am expecting them to continue to be a very lucrative business in terms of cash flow and profit margin going forward. So I mentioned that I've had Zoom video stock rated as a buy all year, and I last updated that rating on September 9th, 2025. So what do I think about it following the earnings results? Well, when I go to fiscal.ai, which is my preferred data provider to retrieve the company's market multiples, on a forward PE basis, they're trading at a forward PE of 15, and on a forward price to OCF, it's at 12. These are ridiculously cheap valuations for a company that boasts these levels of profit margins while still growing the business, albeit not explosively, right? The most recent quarter revenue increased by just 4%, but that's still growth. And when you're growing 40%, but at the same time you have margins approaching 25% operating and 50% CFO to sales, that's a lucrative business that can compound very nicely over the longer term. But the reason why it's trading at such a cheap valuation is because of those deeper pocketed rivals I highlighted earlier, slowly attracting and chipping away at the competitive advantage that Zoom Video boasts. By the way, Fiscal.ai is running a Black Friday promotion. And if you see the link in the description and click that link, you'll get a discount of 30% during the Black Friday sales event. I highly recommend you check them out. They saved me a whole lot of time when conducting investment research. They aggregate a lot of the information. I think you'll be happy with their service. By the way, did you know about our exciting channel membership program? You get so much for less than $5 a month, including dozens of exclusive videos, access to exclusive research on over 100 stocks, and early access to many of my videos before everyone else sees them. Click that join button below to learn what this program is all about.